Welcome to the Monopoly Mindset, the podcast where we uncover the strategies to build your real estate portfolio one property at a time.
We're your hosts, Tyler and Tommy, here to share our story of playing real-life Monopoly.
Whether you're just starting out or a seasoned investor, this is your go-to resource for mastering the real estate game.
So grab your board, roll the dice, and let's buy Boardwalk together.
Welcome back to the Monopoly Mindset, episode 24. Last week we talked a little bit about the Airbnb from Ty and I going on our family vacation. And this week we're going to talk about all the ways to finance a property.
Yeah, we realized that we've been using all these terms that might come natural to us. Things like DSCR and hard money, 203K, but we basically just want to do a whole episode dedicated to different forms of loans, like different ways to purchase a property, and then just more like creative things like HELOCs and private money and seller financing and things like that.
Yeah, there's so many different varieties of loans out there that honestly we didn't know a ton about when we first got started either. Like you learn about the FHA or 5% down and really conventional routes with all that you know or think of. And even sometimes then you think you need 20% down, and learning you can put 3.5% down or 5% down, or if you work for the government, in some of the VA loans out there, you can get away with 0% down in some instances. So I think just opening people's eyes and talking about some of those other products and ways to get into a loan can answer some questions that people might have.
Yeah, for sure. You definitely, I remember being told, you shouldn't buy a house unless you put down 20% because of PMI, and then you're like, what? So I'm going to give up all the benefits of buying because I have to pay $100 a month in PMI. But anyway, we'll get there. So first we're going to do our weekly pass and go segment. It'll probably be a quick one. I don't have too much other than I've been packing my house because I'm closing Thursday. So in 3 days, I'm super excited. But we're going to get in there and paint a majority of the house, at least the first floor and the master bedroom, and hopefully get a bathroom done, and just a few of the renovations that we want to do before moving in. So probably move in 3 weeks or so. But yeah, other than that, I haven't really been putting a ton of focus on investing right now, because I just want to figure out my primary and get settled, and then I can come back to the investing part.
Did you get your paint sprayer yet for the new house?
I just during dinner Googled which one I'm probably gonna get, but yeah, my brother had a pipe leak. He just bought his house, so this happened within 2 months of buying a flipped house, so he wasn't very happy, but he had a pipe leak and ruin a lot of his LVP vinyl plank, and so he filed an insurance claim, got it all replaced, and he told them that he wanted to keep the old plank, so they kind of take it apart pretty carefully. So I went over to his house today and picked that up, so I'm going to put that in my basement now instead of this tile. That stuff's heavy. I don't know how many cases it is because it's all individual, but it was a whole truck bed full. So, but free flooring's free flooring. So,
doesn't sound like fun. I love the Home Depot packed box behind you for this episode. Feels very fitting for what you're going through.
Yeah, my background will probably be a mess for 3 weeks, but I'm excited to have a more official setup in my new space. So,
yeah. Well, right congrats on getting clear close. I know that's always tricky, especially with conventional loans when you have to have a lot more docs and things like that to get to that point. You always know that you're going to get there, but it's sometimes a different process.
Yeah. I don't want to jump the gun too much on the episode, but real quick, just for conventional, because I'm going through it right now, typically the way that it works is, I'll just give the 30-second rundown. You get a pre-approval. They typically, especially if you have a relationship, they typically just ask how much you make. They don't always, maybe pay stubs, but that's about it. You get the offer accepted. then they ask for a majority of the documents, but then it goes through underwriting. Underwriting is going to keep asking for more documents, with, usually like 2 to 3 weeks before closing. And then usually like a week or so before closing, underwriting says, hey, you're clear to close. Then you get the wire instructions, and then you go to the bank, wire to the title company. So I'm at the phase where I'm going to go this week and wire the down payment to the title company. But underwriting is the most stressful. They just keep asking for more and more stuff.
Yeah, for sure. I have a love-hate relationship with underwriting, for sure.
Where's the love coming from?
When I get that clear to close email, or when they say, hey, we don't need any more additional documents, those are probably my two favorite emails from them. Other than that, it's typically a pain in the butt. I mean, when you have a decent amount of properties and you have to scroll through and get all the documents that they need for all of them, and then like even in commission, it's always been a tougher process too, because they'll only look at my base salary and then they'll say, okay, well, what are your last 3 months of commission? It's like, all right, well, I've made this last 4 years in a row. And it's like, well, we're only going to use the last 2 months. It's like, well, it doesn't necessarily seem fair. You have a collective basis of 3 years worth of work versus the last 2 months. And I mean, in sales, sometimes you're hot, and sometimes you're a little bit colder than other months or when you want to be. So it makes it a little bit tougher when you're going through that underwriting process in a sales role specifically.
Yeah, and I didn't like, same thing with owning property already. I didn't realize like how hard it is sometimes to get income. So like I had two issues, not issues, but like things that lowered my debt to income ratio, which impacts interest rate. And one is I bought my duplex in 2023 halfway through the year. Well, I haven't filed my 2024 taxes yet. I did an extension. So they're using the 2023 tax return, and the income is only half because I bought it halfway through the year. So the income there is half, but the debt is this, it's the monthly payment. So that's the same. So I have 100% debt, 50% income for that property. And then my current property, they're not using income at all, as I understand, unless you have a signed lease in place before closing, which I don't, because I'm going to do some work to my current property. So that's another property that I have 100% debt on and zero income. So yeah, the more properties you have, the more complex it gets. But
Yeah, and we talked a little bit offline about this too. And I'm very thankful that you both, got to this process and you're clear to close. But I was definitely nervous throughout your process, just because you have a lot going on. I mean, you'll essentially have three mortgages under your name without necessarily like income coming from them, because the Airbnb, they're not going to count that income for what, 2 years, I believe it is. And then obviously your current house, you don't have a lease in place, so you're not getting revenue from that. And then the third house is the house that you're moving into, so they're looking at you as having three mortgages with no additional income, which makes it much tougher on your side to get approved for a loan. So it was very,
yeah,
it was great that you were able to.
part of me is like, am I being stupid? Because like on paper, I can't afford this place. But then I was like, well, actually, I do have income for I'm gonna get this place rented out for a good amount. It's just on paper, and I am going to file my taxes this year. So, but yeah, well, again, we're talking a lot about what we're going to talk about in the episode. So, how was your week? I know you were still working on some renovations yourself.
Yeah, so my renovations are all done. Woodlawn's pretty much ready to go. It's been weird. Like, I don't know exactly what's going on with trying to get it rented out, because I reached out to, like, I go on Zillow and I'll see like it's got 34 contacts. Like, to me, 34 contacts seems pretty decent, right? It's better than three. It's
Yeah, it's a lot.
100%. Yeah, but it's not rented. I'm like, what's going on? Like, 34 contacts seems like a lot. Like, why are we struggling? So I asked the property manager, like, hey, does this mean 34 people? Like, to me, it means 34 people have reached out. He's like, yeah, it means that they reached out, but like maybe I haven't gotten back to them, or maybe I've missed it. I'm like, all right, can we get on responding to some of these folks? Because I was hoping to get this rented for August 1st, and at this point, that's 4 days away. I don't know exactly what's going on. So the renovations were completed about a week and a half ago, and it's basically ready to go. We just need to find somebody that we can rent it to and get it rented. So that's been frustrating on my end. Like, you get a property, it was a quirky closing process, and then you got the renovations done. I was hopeful I'd get it rented. It's still out there, which, to your point, you're going to get your current property rented once you move out, but you don't necessarily anticipate. I know they say save for those months when you have vacancy, and I definitely did that, but starting off 3 months of vacancy isn't the best position to be in. So I'm excited to get that property rented out here soon and figure out what's going on with it.
Yeah. I think it's also just your area. Like I got 10 people reached out to me the day I listed the duplex, and somebody signed the lease like the next day. So I'm not worried about my property at all, but I think just that area is a little more not rural, like it's not farmland by any means, but it's definitely not as like populated as where I'm living. Um,
Yeah, you're right, but it's definitely popular. Like rentals there fly off the market, and like unfortunately, like talking about divorce, but there's so many people that get divorced. I mean, in that area and like every area specifically. So there's typically like a family that wants to be in the better school district and whatnot, and it's pretty much the only 5 bedroom, 2 bath available in the market. It's priced at $2,000. So I think it's in a good spot. Went from like 25 to 34 views or not applicants, but contacts in the last 2.5 weeks. So hopefully that's something that we can get some traction on this week, and I'll follow up with the property manager and see where that's at. I got a different text for Overbrook today that the hot water heater broke this morning, so there was water flying all throughout the basement, and that's got to get replaced. I talked to the property manager. We're going to try and get a plumber in there ASAP to swap that out. So that's always fun when something like that goes, but the positive is it breaks and then you replace it, and hopefully it lasts for another 5 to 7 years, and you don't have to worry about it again from that point.
yeah, so the you had a pretty realistic week in real estate, the lows, not the highs.
Yeah, we've been living on the lows the last couple of weeks, having a lot of things going on, but we finally had our tenants move into the bottom of 42 Mill Street, so that was a positive. To finally get that place rented. I told you a couple of weeks ago we have 3 GAs moving in there instead of 2, so we're getting a little bit of extra rent. Got the utilities in our name, so some things are going. And TDJ overall, we've been looking at potentially taking property management back under our umbrella. So we've been checking out a lot of different applications. I know we've gone through Rent Ready, that's who we've used in the past, but all of us are kind of taking 2 different um, apps and like just doing some research on them. I'm going to dig into Turbo Tenant sometime this week and see if there's any apps that we like better than Rent Ready, and potentially make the switch or do a free demo, try it out and see what's those apps are about. With the way AI works and apps anymore, like you can, I don't say manage a property completely through them, but they can really simplify like how you manage a property and make it very simple for the tenant to put in requests and to document everything and have like one form of communication. So just want to try out some apps and see if something like that is better than how things are being ran today. Just always trying to improve and make the tenant experience as good as we possibly can.
Yeah, dude, Rent Ready, I don't pay for this, but like when I get to the point where let's say I have a few more properties and I still don't have property management, you can pay for that like maintenance service where the tenant files a maintenance request on Rent Ready, and they already have a team of people that they will call them directly. So it like obviously Rent Ready's like a national company, but like they'll have a local team of maintenance people, let's say a plumber, an electrician, whatever, handyman, and you can pay Rent Ready like $40 a month or something. Where if they make a maintenance request, it goes directly to that local person, and then so it's kind of like you don't have a property manager. It's not nearly as expensive, but you still have that like local direct contact to like a handyman. So I would maybe look into something like that. It's
Yeah,
kind
it's
of like
called Latchel. I've actually used it in the past, and it worked well. Some of the issues became you can upload your own personal contacts into it as well, so it'll like call who you designate the handyman or the plumber and things like that. So I've had it call people on my behalf too, but then like how contractors are, sometimes they don't want to call, or like they don't want too many calls. Like, hey, I'm going to get to that next Thursday, and then so Latchel was calling these people like 3 times a day, saying, hey, where are you at? Like, what's going on? Give me an update. They're ignoring it because they know they're going to be there Thursday, and they got like a bunch of calls. That was the only feedback I had, which isn't necessarily bad on Latchel's part. It's just the way contractors hate being followed up on and double check their work and things like that. But that was like the main issue that I ran into with it. But other than that, it seemed to work fine. And then I got rid of Rent Ready shortly after using Latchel, so I didn't get to experiment too much with it. But it was cool when I was using it.
Yeah, I think it's one thing that all entrepreneurs struggle with is like the control freak aspect of like you just know that you would do everything the way that you would want it done, but you can't scale that way in real estate. Well, most people don't want to manage 50 properties, right? But some people do. But like it's just part of the I mean, owning any business is like, let's say you open a mechanic shop, you can't work on 6 cars at once, so you have to hire people, and maybe those people aren't going to do the job the way that you want it to be done, but it's just like part of growing a business. You have to eventually hire employees. So, yeah, I think it's a tough
Yeah,
thing for people to learn. And like, I definitely struggle with that. Like, I still manage my property, and like, I just do everything exactly the way that I want to do it, the day that it needs done. But there will be a day where I'm not going to do that, and it's going to be frustrating when people aren't, doing it the way that you want it to be done. But yeah,
yeah, it's a big struggle for me just in general. I feel like I have a certain way of doing things, and I want things done quickly, efficiently. I'm almost too nice. I'd rather do things for the tenant to get the property in better shape or respond quicker and take like the best care of the property that I can and like have issues resolved immediately. And then sometimes you realize like a property manager isn't going to care about the property the same way that you do. And it's a tough trade off. It's like, all right, maybe they're right. Like, it's okay if this takes a little bit longer, but then you're just always balancing this fine line of like, did they wait too long? Like, should I just step in? Should I not? Like, am I paying 10% for property management and everything's supposed to be completely hands off, but I'm half hands on? Is that my fault? Is that the property manager's fault? Like, there's a lot to manage when you have a property manager. Either have to be completely okay with letting them do their job and be okay with them not doing it to the standard that you hold yourself to, or managing the property. And like, I'm kind of at that in between where I think there's around 11 or 12 properties that I'm part of that we have rented out. And it's like, do I just take ownership of that again and like try to get, because when you're paying 10% and you have a significant rent roll, that's paying a lot of money out of pocket to some, for a property manager. And if you don't think the job's as great as you want it to be, it's like, well, I might as well just do that and take a percentage of that versus not getting, maybe the care that you want. You're paying, like, it's a significant cost once you add it up. And it's just something we've been weighing, trying to figure out what the best solution is moving forward. But being long distance makes it a little bit tougher to then say, hey, I will take it on. But like you and I do, we have somebody boots on the ground. We pay 2%, Ian, and that's worked out well. I paid him again last month. He did virtually nothing.
yeah,
Credit to him, like being on call. We're going to pay him again here in a couple of days, and we'll keep that going. But I'll see if maybe that solution, paying him 2% to be on call, could be a little bit better.
yeah. Because I mean, like, I don't care at all to pay him the $70 a month if he doesn't do anything that month, just because we have the feeling that if something needs to be done, we have somebody there. So it's nice. Like, I don't want him to do anything. Like, typically if he
Yeah,
has to do something, that means we have to spend money. So like, good if he doesn't have to do anything every month. But it's nice to know that we do have somebody in case we have to do something in person. But all right, if you don't have anything else, then let's jump into different types of financing. So we're gonna start out with more of like your classical approaches, things that you might have heard of already. Probably spend like a minute or two on each different type of loan. There's probably like 10 that we are really going to focus on. The first one being probably the most known, which is FHA. So have you used an FHA? I have not.
yeah. Well, not wait. I believe when I first bought my house, my first primary, I did use the FHA loan because I put 3.5% down, and I had PMI, but then you also have like $100 FHA fee or something like that too, I believe.
Every
Um,
month?
I'm almost positive that I had an additional fee for going FHA versus just having the traditional mortgage insurance. Like I think there was something for FHA. I could be wrong on that, but I'm almost positive like I had two extra charges and one was for the FHA loan.
Okay. Yeah, so we're gonna give the knowledge that we have. Again, we're not loan experts. I don't know everything about every type of loan, but we know the basics. So FHA, I think the big thing that people get sold on is 3.5% down. Other than VA and USDA, it's the lowest percent down. So I think a lot of people hear 3.5% and they just automatically want to do that. I would recommend to try and do 5% down conventional. And also these are owner occupied loans, so you have to live in the property. I believe most of the contracts say 12 months, and then you could theoretically move out. But we're for now we're just talking about owner occupied. So yeah, 3.5% down. But like you said, there's higher interest rates, higher fees. I believe it's easier to qualify for an FHA than a conventional.
It
So
is, but then like another requirement is the house has to be in like tip top shape. You're
yeah,
typically not getting a fixer upper with an FHA property. When I bought my first property as a part of closing, we needed like a handrail added onto the property. Like they try to do little things to take care of first time home buyers that like so they're not buying a property that's a complete fixer upper. They want to help them get into like a sturdy home, a starter home.
yeah. So I mean, I guess that could be used to your benefit to protect you, but like you have to get an inspection. Obviously, you have to get an appraisal because any financing, typically you're going to get an appraisal, except for some of the ones we'll get into later. But the biggest con from my perspective, one is interest rate, obviously, if it's a little bit higher, but two is PMI is there for the life of the loan, no matter how much equity you have in the property. So for people that don't know, PMI is mortgage insurance. So I believe it's basically if you foreclose, the bank has insurance in case of a foreclosure. So you're basically paying for insurance for the bank, as far as I know. And with a conventional PMI, oh, and they require you to have PMI if you put down less than 20% in most, I believe, is like a blanket statement. So with a conventional, once you're at 20% equity, whether that's because you've been in the house for a few years and it's appreciated, or you've paid your loan down, or you've done renovations to raise the value of the house, you can call, get your house reappraised, and get that PMI removed from your monthly payment. I did that at this house after 3 years, and it was only like $70, but it's $70 a month that you're just, throwing away for nothing. But FHA, in order to get rid of PMI, I believe you have to refinance, even if you're at
Yeah.
50% or 90%.
Th-
It's there, I believe, forever.
That was what I was referring to earlier. What I was meant to say is that I could not get rid of my PMI even after 5 years of having that loan. Like it does not go away on an FHA property. So I had to refi out of it to get that off of it.
Yeah, so that's the biggest con that I see. So I would definitely recommend if you can afford the extra 1.5% and you can qualify. I guess that leads us into the next most common, which is just 5% down conventional. Pretty much everything we said about FHA, but I think it's a little bit lower of a rate, a little bit lower closing cost up front. To your point, not as strict on like the condition of the house, but still pretty strict, right? Like if you're putting 5% down, the house still has to be in pretty good shape. But
Yeah, but you don't have to go through like the FHA requirements. And so, say if I was selling my house and I got three offers and one of them was an FHA, you kind of know it's a first time home buyer and that there's going to be some extra restrictions or requirements. And like you think about inspections, they're just going to come up with like more things that need to be replaced or fixed and repaired. Where it might be more attractive for me being the seller in this scenario to take somebody that doesn't have an FHA. So sometimes using an FHA loan isn't going to give you as much credibility. Where if you're just a conventional loan, and even if you use 5%, so it's only 1.5% more down, you're going to have a little bit more weight in the buying process going with the conventional mortgage because the seller is going to know you don't have some FHA requirements as baggage.
Yeah, and you can do no inspection with a conventional loan. Like I did no inspection, putting 5% down, so you can definitely do that. But yeah, comparing those two, I would probably go the conventional route if you can afford it. And we're also coming at this with you want to put the lowest possible percent down. You could put 20% down, not have to pay PMI at all if you want. I think that definitely was way more standard back in the day. But yeah,
Yeah, I have a separate, different conversation for a different day, but I had an argument, it really just like a back and forth with a friend over the weekend. And it was a lot of, I think it's smarter to save up 250 grand and buy a house cash versus putting any money down and leveraging to buy real estate. And so I kind of went through a scenario of like 10 and 15 to 30 years of who would buy more houses and have more money. The guy using the 250K buying 10 properties and like using leverage, or the guy saving up 250 to buy one house at a time. You can probably guess who
yeah. I'd like to hear
won.
his argument, but I don't know who it is.
It's your favorite landscaper.
Okay, okay.
Yeah, he hates debt. He hates paying any sort
But
of
doesn't he own two houses?
yeah, and he wants to pay the one off or sell it because he hates paying interest and he thinks it's the dumbest thing in the world. Which I'm not disagreeing. And like he's what started was he sent me something about Dave Ramsey, and it was Dave Ramsey like telling this guy who had I think 200 grand saved up and he wanted to buy a $300,000 house as an investment. And Dave's like, don't buy it. You have no money. You're broke. Use that money and save up until you get another 100 grand and pay cash. Don't put 50% down. Don't put 70% down. You're an idiot.
Yeah,
And
yeah, that is a long conversation for another day, but
yeah, for
maybe
sure. But yeah,
yeah, we're in the leverage mindset right now. So as we get older, I will definitely start to transition my mindset on debt, but for now, I'm going to put down the least amount I can and acquire as many properties as I can. But anyway, so the next one that some people might have heard of is 203K loan, which
no one's heard of that.
you don't think? I don't know.
No, like I mean, we talk about it a little bit, but before we talked about it, I didn't hear it that much, and like it's been getting more popularity recently, but I don't think it's something that a lot of people know about. In my opinion, it's one of the most important loans that people should know about because if you're just getting started in real estate, this has got to be the best way to get started. The Wealth Juice actually just did an Instagram post about this earlier today. Not sure if you saw it or not, but basically said, take out 5%, get a 203K loan, buy a 4 unit, fix up the other or all 4 units really, live in one of them. So yeah, the 203K loan I think is one of the most powerful real estate investment tools in the market right now.
Yeah, so there's two versions of this. Most people just refer to all of it as 203K, but there's 203K, which is an FHA loan, so it's like FHA 203K, and that's 3.5% down. There's the same thing for conventional, and that's called home style. And then you can even do an investment home style, which the Wealth Juice did do that. And that is 15% down for an investment property, which is awesome. But these loans are renovation loans tied into the purchase of the property. So let's take the FHA 203K as an example. You can put down 3.5% of the purchase price plus the renovation cost. So you buy a house for 80, you get a loan for 20,000 or the renovations are going to cost 20,000, so you're all in for 100. You can put down 3.5% of that, and that is such a powerful tool versus putting 3.5% down on the 80 and then spending the 20 out of pocket.
Yeah, but it becomes so powerful too because then you can use that 20K to do the renovations, and now this house that might have been worth 100 or 110, if you do the correct renovations, you can make it worth $150,000, and now you have built-in equity because you used the this loan to your advantage to fix up a property and kind of get that sweat equity, but you're not necessarily doing that work yourself. You're kind of using the bank to flip a property in a sense.
Yeah, I will say a big con. I've never done it, but from what I hear, it can be a little difficult in terms of the renovations. It seems to me like a lot of realtors don't like it. A lot of, not all lenders are very experienced in it, but it can be a little difficult because the bank has, I guess they assign you like a liaison for the renovations, and they have to go like make sure the work's getting done. I think the bank pays the contractor directly and like in certain draws. And all of that's like pretty typical in a renovation. I've just heard from multiple people that because it's like FHA and it's very strict, it can be a little difficult to navigate like all of these moving parts with the contractors. And I think like at one point they had a list of contractors. I don't know that that's true anymore, but I believe they definitely have to be like certified and like pull
Yeah,
all the permits correctly and everything. And they're going to make sure that everything's being done like 100% up to code and all that.
contractors, like we discussed earlier, they don't like when people double check their work, and so in this scenario the bank might have to send a liaison out to double check the work or get picture confirmation that X, Y, and Z was done at the property. And then the contractors also want to be paid quickly, efficiently. I mean, if you want to have a contractor in your pocket, pay him cash, pay him Venmo, pay him immediately. If you want to piss off a contractor, tell him he's got to wait a week to get paid because you have to get verification and send the bank payment. So it's almost better like if you had that extra money in your pocket and you could pay the contractor up front, and then like I guess the bank has to pay that check out. So I'm not exactly sure how to get that to work, but the contractor's
Right.
always going to want to be paid sooner rather than later. So the longer they have to wait to get paid, less happy they're going to be. They might drag their feet until they do the next step of the process. So a 203K loan is going to be more work, but again, with anything in life, the more work that you put into something, that's how you're going to make more money. And the 203K loan gives you those benefits. And one of the highlights, in my opinion, of this loan specifically is you can afford a significantly more expensive house than you think you can because they take into account the rental value of your other units. So if you are going to buy a quadplex, you get to then take the, let's say the other units are $500 a pop. Well, now you get $1,500 towards your income. So if you're making, $60,000 a year or whatever, and you're getting 3-4 grand a month in your paycheck, well, you get that plus the $1,500. So it looks like you're making even more money. So you can qualify for a property instead of being 200,000, maybe up to 300,000. Or you buy the $200,000 property, but you put $100,000 of work into it because now you qualify for a bigger property with more renovations. So that's again more the power of the 203K loan. You can't tell, that's probably going to be Ty and I's favorite loan for new investors to get started or to learn more about. That's my guess for what our favorite is.
Yeah, I mean, I wanted to use it on my property now, but the one that I found didn't need enough work where I'm just going to pay for it out of pocket. It didn't make sense. It's probably a higher interest rate than just a regular FHA or a regular conventional. But I think the power of putting that little down, and you can do like a large renovation. Like there's certain numbers, but like I want to say you could almost buy $100,000 house and do $100,000 renovation as long as they do like an ARV appraisal that we've talked about. So they're gonna appraise what it would be worth after you fix up, and they're not gonna lend you like 300 grand if it's only going to be worth 200 after, obviously. But yeah, so just to recap on that, FHA 203K loan, 3.5% down, you have to live there. Oh, and then one other thing is you actually now don't have to make the payments until you move in. You don't even have to start making payments. So like if you have a 6-month renovation, you can not make your payments until the 6 months, until the renovation is done and you move in. So you don't have to make like double mortgage payments or like pay your rent and your mortgage.
I wonder what the caveat is if you do it with like a duplex and you rent out the other unit and somebody's in there paying rent, but you technically haven't moved in. Like, can you stack that extra cash for a little bit
Yeah, I
until
don't know,
you're,
but also you're still paying interest, so
yeah,
your balance is actually going to go up in those 6 months because you're paying interest and no principal at all, or no payment at all, but it's still accruing interest. You're not paying it, so that can actually stack up pretty quickly on that size loan. But yeah, so home
I
style.
would guess if you do a 203K loan though, like I'm gonna assume most people, you do that loan, you get the work done, and like you hope that the property appreciates even more than what you thought it was going to, and it's a loan that you get in to get the renovations done, but then you kind of refi
Yeah,
out of it in like a year, 2 years, whenever that seasoning period hits, or like say if you were living there for 1 year, like as a primary, then you move out, then you refi, you pull the cash out, you use that to then repeat and do something else somewhere else.
yeah, yeah. That's what I've been told, even from banks. Like, hey, if you're gonna do it, you probably were only gonna stay in this loan for like a year. It's kind of like hard money into a burr. But
Yeah.
as you live there, you can put down way less. So 3.5% down for 203K, 5% down for the conventional version called home style, and then 15% down for an investment property. Um, and then I think the last two that we aren't as familiar with for living in a property is VA and USDA. And those both allow you to put down 0%. Now, I think VA is only for veterans, so it doesn't apply to most people, but I know someone that's done 0% down. You still have to pay closing costs, but it's 0%, of the of the purchase price. I don't know much about this one at all. I don't know if you can use it more than once or if it's just like a one-time deal, or I believe every veteran qualifies. But I'm not a veteran, so I don't have a ton of experience with it. And then same thing with USDA. I also don't know too much about, but I believe the idea is if there are areas that are rural that they want people to move to, there could be like USDA qualifying areas. Um, so like farmland, I guess. But you can qualify for a USDA loan and put down 0%. But again, I don't really know a whole lot about it.
Yeah, I think with the VA loan and these other loans that there's no restriction to how many times they can use it, but the issue will most likely become like again debt to income ratio. It's great to put 0% down, but if you're buying a house for $100,000 versus putting 20% down or even 5% down, your loan's going to be for slightly less. If you're going in with 0%, it is a great loan to get in like with no money down, but you're going to be paying a lot more on a monthly perspective than if you utilize some of the other ways to get a property.
Yeah, that's actually a really good point. Is like we're using 5% down, but there could be a case where, to your point with debt to income, they're like, hey, you actually have to put down 10% because then the debt goes down a little bit. The monthly payment goes down a little bit, and you might have to put more to qualify for the loan. So that is an option. But yeah, it really depends on, your own situation. And I believe that's all oh, actually, two more. Sorry. So there's jumbo. There's jumbo loan, which I really don't have experience with, and that's I think the standard in 2025 is just 806,000. Anything above that is a jumbo loan, but then it's also area dependent, so it can go up or down depending on the area. And I
So
think
that's what
that
we'll need to buy the Shamum Castle, right? Jumbo loan.
yeah, yeah, and I think that's just an extension of like a conventional loan. So, but it's like a different product because it's more than 800 grand. But in California, it's probably like 2 million. In North Dakota, it might be like 600,000. I'm assuming North Dakota is one of the cheaper states, but yeah, don't know too much about the jumbo loan. And then what else do we have? Oh, second home. So this is not an investment or a primary, but vacation home, second home. You can put down 10%. Also not not nearly as good of terms as a primary, like interest rate, but better than.
It used to be pretty similar, right? To a primary loan, like the interest rates
Yeah,
weren't
I've
that
heard.
bad, but like since a lot of people use this to buy Airbnbs and then became a lot more liable because of that, the banks have changed the restrictions and they're almost like a percentage point or 2 percentage points higher than a typical loan.
Yeah. So those are all the ones that I know about that I've heard talked about a lot. But if you just need to remember one, it's 203K or 5% down.
That's definitely the one. Like, if you hear something or if you're trying to get a property, I would look into that the most because you can buy a fixer upper and get a lot of that sweat equity done. And that'd be my recommendation. You might not know a lot about it, it might sound confusing, might sound like too much work, but honestly, you're going to get the best return on your investment if you do a little due diligence and do some research on that type of loan. Find a lender that works with that loan and find a realtor that'll guide you through that process. That would definitely be my recommendation. But then to get over to the investment side of things and looking at investment loans, Ty and I's favorite loan that we use probably the most, or at least I use the most right now, are DSCR loans. I love them because they don't have the DTI requirements, they don't have the doc requirements. It's just feels free and easy, and not that's always a great way to feel when going through and doing business. Like you want things to be double checked, but they look at the property, they make sure the property cash flows, and then they kind of give you a loan. You're going to pay a little bit extra in interest, but once you have like a decent amount of properties, it feels like it's, I don't want to say smarter, but it's just so much easier to go through this process and not have to get all the documents and the hassle of going through a conventional type of mortgage or going through a conventional business loan. And then sometimes they still might not get approved. You can really only have up to 10 loans under one person before banks start getting even more skeptical of giving you money. And that's why a lot of investors just go with DSCR because it doesn't give them any headaches and it's just quick and easy to move on. You don't want to be heckling with financing and trying to get that figured out. It's much easier to have like a DSR loan in your pocket. And then once you find the property, you can just quickly act, get the property under contract, and then just move on and find another property from there. So that's, I think, why the DSCR loans became so popular.
Yeah, do you have any DSCR loans under your name?
Yeah, I just got one. Woodlawn is a DSCR loan under my
Okay.
name.
So DSCR you can get under your name, your own personal name, which
Hmm.
I probably would have recommended against that. If you're buying a new house as a straight up investment property, I would recommend putting in an LLC. But a DSCR allows you to do both. Whereas another option for investment is a conventional loan, but it has to be under your name. Um, and both of these are around 20 to 25% down, depending on the bank. As far as I know, it's pretty difficult to get less than 20% down, other than that home style loan. So yeah, conventional for investment, 20% down, but only under your name. And this is something that I didn't know when I created my LLC is they will not lend to LLCs. You have to go more like DSCR or like commercial loans. But yeah, one thing to your point about DSCR I've noticed is the banks seem to be like smaller and can kind of make up their own rules. At least like I was talking to a guy and he was like, "Yeah, like we'll do 20% down." And I was like, "Okay, what if you take this property of mine that has 100 grand in equity and you attach yourself as a second lien and then can I do 10% down?" And he was like, "Yeah, probably, like we could probably do that." So it's like you can kind of like work with them and come up with, I don't know. They don't have like the federal government giving them the regulations. They can kind of do whatever they want, which is also kind of the reason that there was this massive DSCR blow up in Baltimore 2 weeks ago. It's I, I keep talking to my lender about it that I'm using to buy my new house, and he's basically just saying it's like a lot of money rushed there very quickly, and it's kind of just the wild wild west. So not that like you're gonna get like screwed if you use a DSCR. It's more just like, are the banks gonna get screwed if you know people start to foreclose? But yeah, we've each used it. It's a great product, lower interest rate, but quick and easy. That's like the biggest con with DSCR. Quick and easy. Like, here's the rent. here's the payment. Okay, you're approved. No income, no W-2, no taxes, etc. And you could do it for an LLC. So, um,
Another option are like portfolio loans. This is something I've done. I'm actually in the process of trying to get rid of them because they can be a little bit of a pain in the butt. And like a portfolio loan is really like, say if you have multiple properties. In my example, I took 3 properties to the bank and I said, "Hey bank, I think these properties are worth X amount of dollars. Can I have a loan for all 3 of them?" And we'll put it on, but I just want one loan. I don't want to have an individual loan per property. So the bank looked collectively at what each property was worth, and they gave me one lump sum loan. So I just had to make one payment to the bank, which to me sounded great, sounded simple and easy. I didn't have to go through the process 3 separate times, just got to go through it once. But I'm starting to see like the downside of that is now, like if you want to sell a property, it becomes a little bit more difficult to get out, like drop from 3 properties down to 2. I did it, then I had to get my other 2 properties reappraised, and it became like more of a headache. And now I'm trying to potentially sell one of those houses, and it's like, well, I have to redo this loan again. So portfolio loan is basically getting multiple houses on one loan. It can work out. It worked for me at the time. I'm starting to see I don't necessarily love them on the back end once you do get out of them. So they're an option, but I would again probably lean towards going DSCR route just because they're quick and easy and you can refi out of them pretty quickly. That would be my recommendation, is to stay away from portfolio loans.
yeah, I have not done it, but I agree it could be difficult when you want to sell or like get a HELOC or like try and maybe do like a rent to own scenario or something like that. I don't know.
And it depends like who they're with, but mine's with again the commercial bank, and we've already said that sometimes on the commercial side banks are tougher to deal with. So now I'm going to this bank and I'm like, hey, I want to refi property A and then just keep this portfolio loan and drop it down to one property. And they're like, well, that property makes $300 a month in cash flow, so we can give you a loan for $12,000. It's like,
Yeah.
okay, it just, all right, yeah.
Yeah. So
So
another I guess this is more just a general commercial loan. Now we're talking like bigger buildings. Again, I would love to get the experience. We're not there yet, but like let's say large apartment buildings or like a warehouse. I don't know anything about the interest rates, but I do know that those are typically adjustable. I guess I should say that up until this point, we've typically been talking about you can do a 30-year fixed rate with all of these loans that we've mentioned, except now we're getting into like commercial, which is adjustable, and I believe the numbers are more based on like cap rate and NOI. So especially like when you get an appraisal, it's based on how much does the property generate, not necessarily comps. Because you could have a 50 unit that generates a million a year, or you could have one that generates 600,000 a year, and the one that generates a million a year is going to be worth significantly more because people are buying it as a business. So it's just like sales, right? Like revenue. It's not necessarily like comps. But again, I don't know too much about it yet. Hopefully we'll get into that space one day. But
yeah,
yeah, and
it
then
seems to be like the one property that when you hear a lot of people talking about like the commercial real estate market and like it's going to crash, or a lot of it seems to be based off of that. These people get these 5-year loans and they bought them 5 years ago, 2020 rates are what, 3-4%. Now they're 7%.
yeah,
So these people like had a property for $1 million, and at 3% it worked out fine. It was cash flowing wonderfully. But then you double that loan or more rate to 7%, and it's not working out as well. You're paying a lot more to interest, and like you have to get a new loan because your loan is 5 years, and then it refreshes at whatever the new rate is. So those are the types of properties that can get you in a little bit more of a pickle or a sticky situation because you had this loan for 5 years. Now you have to get a new loan. Like it doesn't last really any longer, and because rates have gone up significantly, you're not making nearly as much money on a property that you were 5 years ago.
yeah. Now that being said, I know two people that have gotten adjustable for a primary, and right now is like the only time that I would say that might be the smarter decision because the rates are already high. And the reason you would get an adjustable on a primary is because starting out like on month one, you're going to get a much better rate than what the current fixed rate is. So like if the current fixed rate's 7%, if you do a 5-year adjustable, your starting out rate might be 6.5. But again, rates could double. Hopefully they don't go to 14, but right now in the current market, I feel like it's almost everybody's expecting them to go down. So maybe an adjustable is not terrible right now, but you can do that for owner occupied. I think most of the time people just, if you do fixed, you're locking in a monthly payment for 30 years. You don't really have to worry about what the market's going to do.
And we forgot one of the newer loans that we learned about. Maybe we can have Travis David on the pod to tell us a little bit more about the all-in-one loan.
We can't even explain it. It's like, it's not even a mortgage. It's like a bank account. Yeah, people can look up CMG all-in-one loan. It's basically like a bank account that you deposit your checks into, and it pays the interest on a daily rate, and apparently you can save money over time, but I still don't fully understand the math, so
the math is not mathing for Ty, and he's our math expert. So it's something we want to learn a little bit more about. But one of the cool perks about this all-in-one loan that we've learned or been told is, in a typical scenario, a loan, you're going to get a mortgage for 30 years, and you're going to be paying that mortgage off over 30 years. With the all-in-one loan, a lot of the examples that have been showed to us is, say if your daily income or monthly income is like $6,000, $7,000, it's taking that entire $7,000 and it's from a monthly perspective and it's paying off your mortgage, and it's going to make your interest paid off much sooner. And because it's paying your interest off like at a daily rate, you can then borrow, like you still need the money, so then you borrow additional money on like a HELOC or a line of credit against your house, and that's how you can still pay your bills and get access to your money. But it takes like your monthly paychecks and pays down your mortgage faster. And in a lot of the examples that were shown to us, you're paying your mortgage off in 10 to 15 years, which seems insane that you're paying your mortgage off that quickly. So something Ty and I want to learn a little bit more about. It's a product that's been around for a while, but it's newer to us, and so we'll do some more research and try to learn about that.
Yeah, well, I actually went down this rabbit hole as well when I was researching that loan. There's the same concept with a 30-year fixed loan, and it's called velocity banking. And I'm not going to give my opinion on it yet because I haven't done enough research, but it's the same concept where you have a 30-year payment or a 30-year loan. You take 20 grand and you pay off a $20,000 principal payment. Then you open up a HELOC and use that HELOC for your expenses, and then same type of thing where the math, you pay your loan off much quicker. But that's a pretty complex thing. So there's YouTube videos on there. It's called, again, velocity banking. You could do it with cars, credit cards, whatever. To me, it feels scammy. I'm not, so like, I don't know. I guess it's math. It is math at the end of the day. But yeah, I'm going to do some more research on it. But then the last investment type of loan, and this one's kind of special. We say it a lot, but that's hard money. And this is like a strictly 12 months or less renovation loan. So if a lot of flippers are using hard money, BRRRR, if you're going to do the BRRRR method, which is buy, renovate, then refinance, you can use hard money to purchase the property. You can be in any condition. Typically the worse is better, right, in this situation. But extremely high rates, like 10 to 15% high. And then typically 20% down for the purchase price, but the rehab is fully funded. So I've used it once, put down 20% of the purchase, and then I actually didn't have a super large rehab. I know I said you should, but I didn't. So I didn't even borrow any money for the rehab. But again, for like a flip, you buy a house for 100, you put down 20%. It needs a $100,000 renovation. They pay for the whole 100. You're all in for 180, because 200 minus the 20 you put down, then you flip it for 300, you pay them back the 180. Or you refinance and keep the property and rent it out. So this is you probably only know about this if you are an investor. I did not know what it was prior to getting into real estate.
Yeah, it's more of an investor friendly loan, and you're using it primarily to flip a property. It's how to get a property under contract a little bit quicker. They have some requirements similar to a DSCR loan, but you're going to be able to access and get this property moved a lot quicker. Sometimes investors will use this to say they're buying a house in cash. Like the way the bank or the buyer or can look at it, or the seller can look at it, is it'll be presented as like a cash offer, even though it's not 100% cash. Like sometimes they'll say, "Hey, we're offering cash, but like we might have like a hard money loan or something like that." So it looks like cash. It's something that can be done quickly. You're allowed to like sometimes they say if you offer to buy in cash, you can get a deal and a discount on a property. Hard money is a way to say, "Hey, Ty, I'll buy your house in cash." It's really a hard money offer, but the way it's going to look to him, it's going to look like cash. You can get it done quickly. So it's a powerful loan. You're typically going to pay interest only for those 3 4 months. So that's how these banks that are doing it make their profit. They make money during the renovation. You're paying them interest only. Then you refi, you get out of it. There's also points, which is just like an additional payment at the your down payment that goes directly to those banks and lenders that offer that product. So it
Yeah.
works for everybody, but it definitely the banks win. But it's if you find a great property and you can do hard money to get the renovations done, it's a win for a lot of investors to use.
Yeah, I feel like it's and still is like scary for me and you right now, just because you're only getting a loan for 12 months, and if those 12 months are up, like typically I've heard they will extend, like if your renovation goes on a little longer, but like theoretically you owe them the entire balance after those 12 months, and you're at like 12 to 14%. So like in the case of a flip, if it doesn't sell right away and it stays on the market for 3 or 4 or 5 months, like that's 5 months at 14%. So it's I'd say it's probably better for people that are a little bit more experienced. And the more experience you have, the better the terms as well. So,
Yeah,
but
but I think that was a lot of information to take in. Hopefully, you stayed and listened to the full episode about like different ways to get into a property. If you have any questions, feel free to reach out to Ty and I. I mean, we love talking about this type of stuff, going through loan options and like what it takes for somebody, whether it's just get approved for a loan or what strategy should you start looking for, how to get it like the right mindset, how to like double check your debt to income. It's something a lot of people don't necessarily know. Like, what do I qualify for? Like, I wish I could get a property. So if you have questions like that, Ty and I love talking about that and like helping people figure out what they can get and like what loans are available to them. So feel free to reach out to us. We also have a lot of connected partners and people that we work with to get us into these specific loans, people we've used in the past as well. So, talk about it, stop making finances such a taboo topic, and like try to figure out, how to get your next property under contract.
yeah, okay. Well, sounds good. Thanks for tuning in, and reach out if you have any questions.